First of all, you need to work out what your income is and where your liabilities lie, and then try to take action to minimise the ones that are relevant to you. And if you look at it, it's not always just about saving tax either, because for most people, a sensible strategy is pay down your debt, whether that's mortgage debt or other debt such as credit cards, pay into pensions possibly, pay into ISAs possibly. Those are really the main things that people need to be doing, and the vast majority of people just will not have any capital gains tax issues, might not even be that concerned about inheritance tax issues because they're young. If we took a simple example of someone who's got, say, a couple who've got £10,000 in cash between them, and for one reason or another they've decided not to pay that off a mortgage. Okay, just think about it. If you've got £10,000 in cash, a lot of people will have that just in a current account, earning pretty much zero interest. So just by moving that £10,000 to a savings account earning, say, 5%, you can get more than that, but let's just use 5%, they've increased their interest to £500 per annum. Okay, so that's a great start and something that most people could be doing. But if you take that a step further, quite often what will happen in a couple, for example, is that one might be a higher rate taxpayer and one will be a basic rate taxpayer or even a nil rate taxpayer. So the trick there is to hold the cash in the name of the person who's paying least tax. So for sake of argument, if you move it from the higher rate taxpayer's name to the basic rate taxpayer, you're paying 20% rather than 40%, which on £500 of interest is £100 saving year on year. You can then look at it even further and say, well, why not use your cash ISA allowance? Because for the current tax year, you can save £3,000 into a cash ISA, rising to £3,600 next tax year. All it is a bank account with a little wrap around it saying this is tax-free. It's not rocket science. It's an allowance that we should all be using and aren't all using. If you take that £10,000 between now and, well, 6th of April or on the 6th of April, a couple could get that whole £10,000 tax-free, pay no tax at all on the interest. And it's very straightforward, but people just don't do it. And I think if you're not able to fill your stocks and shares ISA allowance, which it's often quoted that you've got this £7,000 ISA allowance. Well, not everyone has got £7,000 that they're happy to commit to what we'd class as longer term savings, because stocks and shares ISA shouldn't be a 2 or 3 year vehicle. It's probably 10 years plus. But a lot of people will have £3,000 sitting in a bank account to use the cash ISA. So it's important to remember that there is the cash ISA and the stocks and shares ISA. Okay, top tips. I mean, first of all, what we need to remember is that not everyone is paying capital gains tax or has got an estate that's over £300,000 for inheritance tax, and we can all get carried away with these allowances. But number one, we need to get our own house in order, and if we've got debts, we've just got to pay them off. You can't start worrying about ISAs if you've got large credit card debts. They've got to go. If you've got a mortgage that's at an unmanageable level, you've got to really start saving money, cutting down on your expenditure in a big way to pay down your mortgage, because until that's under control, all of the rest is superfluous, really. There's a statistic that 9 out of 10 families could be claiming tax credits, child tax credit or working tax credit. The trouble with the tax credit regime is that you've got to go out there and claim them. They don't just come to you, and a lot of people miss out on these benefits, and those are the people who are in dire need of actually getting those benefits, because it's people on not necessarily lower incomes. I mean, it's up to sort of £66,000. It's not lower incomes, but people at that sort of level might not realise that they've actually got those available to them, and it's free money. All you've got to do is phone up the tax credit helpline, go through a fairly brief assessment. They will send you a form, you fill it in with what your income was, and you either get some tax credit or you don't, but it's up to you to claim it, and people don't. That's the biggest tax allowance or tax break that people are missing out on by not claiming their tax credits. Another key area really is have a look at what is on offer from your employer, because a lot of employers will offer you some form of flexible benefits package, but a lot of employers won't explain that very well to you. And it's not unusual to have life assurance, income protection, pension, various share save schemes, share ownership schemes, perhaps some sort of medical insurance as well. But it's up to you to take action and actually claim those benefits, or do something about them, sign on the dotted line, because otherwise you just miss out on them and it's just throwing money down the toilet, basically. So those are the two key areas. I think if you know that you haven't got any debt, or your debt through a mortgage is under control, and you are definitely making the most out of your benefits through your employer, it's at that stage that you can then have a look at some of the other areas, such as ISAs, such as possibly capital gains tax planning, such as more interesting sort of income tax planning areas, such as using national savings, for example. But you've got to go through the steps that I've mentioned before you get to that point. One of the points in the TaxAction campaign was that we're missing out on £184 million of tax on share incentive plans, and it's really important to understand what you've got through work in terms of share saving schemes. The main one actually is what's called a save as you earn scheme, and through that you can pay in up to £250 a month over either a 3, 5 or 7 year period, and you choose that at outset. And it's one of the few saving schemes where I would actually advocate that people get into debt to do it, because the upside is absolutely enormous potentially, and the downside is virtually nothing. What happens is you commit at outset to pay a certain figure over a certain period of time, and you get allocated a notional award of shares that you will get at the end of that savings period. If the shares have gone through the roof, you're going to stand to make a fairly big profit from it. If the shares have stayed the same or fallen, you don't make a loss. What you effectively get is the money you've paid in, it's effectively held in a bank account for you, plus a bit of interest.